Welcome, everyone, to our February webinar. This is Cary Williams, Portfolio Manager with North Road Investment Counsel, joined by my colleague, as always, Marshall McAllister, and excited to announce our new guest for this month, Eric Menzer from Manulife. Welcome, Eric.
Well, thank you. Good to be here.
Eric, I think we're going to hop right into things and get ourselves going because we're going to try and keep this into a pretty tight timeline. And we've got lots to talk about between Manulife and Real Assets today. We're going to talk about the Manulife Real Assets Investment Fund. And I want to just get us started with an easy softball question for you, Eric. Tell us how you got to the role you're in and how you got to Manulife.
Yeah, no, excellent. Thanks, Cary, and good afternoon or good morning, everyone. So I'm out here in Boston, so it's afternoon for me. Yeah, I've been with the organization for 17 years, and when I first joined, I had my first foray into managing pension assets. So this is large multi-billion-dollar plans that hold multiple different types of asset classes, and that was at around the time 2006 to 2008 that we started to kind of look at things like farmland and timberland and real estate and infrastructure and the types of assets that frankly historically I haven't had exposure to in my prior life in capital markets and trading. So it was quite intriguing for me to embark on a journey of really starting to get to know these types of investments and what makes them tick. Over the years, we've really kind of grown and developed quite a bit within our multi-asset solutions team. And over the last, I would say, 7 or 8 years, we really started to think about how do we take all of these assets that have been historically reserved for your large pension funds and bring it down market, because frankly, the high net worth investors, the retail investors simply just have not had access to this kind of stuff. And we've really kind of seen this evolution in the industry. It's been really kind of fun to watch, to be honest, to see how, in historical context, you needed huge amounts of capital to get an allocation into direct real estate or into infrastructure. And most investors don't have $10 million to put into a single sleeve and take the illiquidity risk, frankly, that gets, that comes with investing in those types of assets. So for us, it's been a huge challenge, and I took it as a great challenge to figure out how do we take these assets and package them up and embed some liquidity in them so that we can actually deliver it through the retail channel and that folks can have access to it where they historically haven't had it. And I think what we're seeing now is not only the evolution of more products, but we're also seeing the evolution of more technology platforms that are making it easier to draw that link between the individual investor and the direct private assets.
So for your role at Manulife, are you only involved in real assets, or are you doing other categories of investments as well?
So I oversee our advisory solutions group, which is part of our multi-asset solutions team. Our MAST team, as we call it, runs roughly about $200 billion across multi-asset portfolios of both public and private assets. So we're managing, bespoke solutions and off-the-shelf solutions for the retirement investor, the individual investor, as well as the institutional investor. Myself and my team are responsible for mainly institutional and customized solutions. So that includes the management of our own pensions at Manulife, the benefits that we provide to our employees in North America, both in the US and Canada, for our defined benefit plans. We oversee that pool of assets. We also oversee our outsourced chief investment officer solutions. So we're helping small to mid-sized pension plans invest in these types of assets as well. Because it's not just the retail investor that has a challenge getting into these assets. It can be the $100 million pension or the $50 million foundation or endowment that just simply doesn't have the bandwidth, the expertise, or the capital to get into it. So given that we do a lot on the institutional front, myself and my team handle that, it was a natural progression for us to kind of take that skill set of the folks on the team that we have, leverage all the skill sets that we have across the organization, and then bring that into an actual product or solutions like we have today with the Manulife Real Asset Investment Fund.
Hey, Eric, can you step back just one step and maybe define what a real asset is in your mind? I know for some of our clients who understand stocks and bonds, the idea of adding real assets, they sort of get that there's a diversifying effect, but they don't maybe understand where does real estate fit versus farmland or timberland, or are there other, asset areas, subsectors sort of within that asset class they should be aware of? How would you define it?
Yeah, so typically you'll break out financial assets or real assets, and your financial assets are your typical stocks and bonds. These are your paper assets. With real assets, it's exactly how it sounds. I mean, you can get out there, you can touch these assets, you can see them. I've one of the things I love about my job the most is I get to get out there and walk around the farmland properties and meet with the property managers that are growing wine grapes or growing almonds or pistachios, and learn about those operations and learn about how value is created. Ultimately, real assets are tied to the real economy. These are assets that are in our everyday lives. These are your multifamily houses. These are your data centers, your cell towers, your wind, your solar farms, your timber properties, which are trees tied to the development of mainly the housing market. So these are everything that you can get out there and touch and feel and see. And one of the unique aspects of real assets is really that there's an inflationary capacity to it. The sensitivities to inflation are embedded in the asset classes themselves. So there is very much a natural inflation hedge, particularly when we see things like food prices going up or lumber prices going up or rents going up on real estate. There's an adjustment factor that can take place in these assets that prove well to be, a good hedge against inflation in those types of environments. So that's what makes it really, really unique. We've seen the behavior of these assets over time and how they behave in a portfolio with stocks and bonds. And we can see that there's a lower correlation or a diversifying effect that takes place by having these assets alongside stocks and bonds of a typical, say, 60-40 portfolio.
Eric, can you speak to the general rate of return experience and the expectations of real assets as an investment category?
So it's a mix of income and capital appreciation. So, typically with real assets, you'll see roughly half of your return come in the form of income. These are assets that have good, predictable, stable cash flows that you can see. That's one of the things I like about it. You're not coming into a blind pool where you're just hoping for capital appreciation. These are real assets that generate income, and you can touch it and see that those dollars coming in. And then you have the optionality, the equity upside potential that exists in the increase in property values, the supply demand that drives that. And, depending on the types of risks that you're taking, which can really span across, something that's a lot more conservative and kind of what we would call core to very much opportunistic type of investing, you can see anything in the range of, say, your core plus assets, which may have return potentials of, say, 8 to 10%, which is where we're operating in for the Manulife Real Asset Investment Fund, all the way to opportunistic, where you tend to have more leverage, you have more risk out there on that end of the spectrum, and that's where you start to get into your kind of, low to mid double-digit returns, but you're obviously taking a lot more risk to do that. And some of those risks include, increased illiquidity associated with them as well. So, typically on this end of the market, we see more retail high net worth investors getting into that kind of core plus. There's some embedded liquidity in there. You're having less leverage embedded in the portfolio, and you're kind of have more of a steady eddy return in terms of variability. But when you get far out on the right hand part of the curve and the risk spectrum, and value add and opportunistic tend to be where the larger institutions will play, the CPPs of the world that can take that kind of risk and be locked in for 10 years or more.
Very good. So can you confirm the Manulife Investment Real Assets Fund that we are in is more core?
Core plus.
Okay.
Yeah.
So less riskier than other real asset strategies that exist, but not without risk for sure.
That's right. Not without risk for sure. I mean, we tend to be mainly in what they call open-ended funds. So these are established funds that have assets in them already. One of the things in this space, as an institutional investor for our own pensions, we can lock up for 10 plus years in a closed-end fund, and we're going in a lot of cases into a blind pool, or we're relying on a deal that the manager has done in the past, and looking for that to be replicated. With open-ended funds, you're looking at an established pool of assets in there that are already there. So when a client buys into them, it's not a blind pool. You know what you're getting right out of the gate. You have a sense of how that's going to grow and some of the deals that are going to take place there. And that really lends itself to that kind of core plus. We really wanted to design this portfolio so that if clients had their only allocation to real assets, that they could feel good about coming into this type of strategy that was more established, and they could see and touch and understand what was going on under the hood.
Hey, Eric, just define blind pool and what you mean by that for folks who may not be familiar with that terminology.
Yeah, so typically what a fund manager will do in a closed-end fund is they'll go out and they'll raise capital. They'll say, like, listen, for the next 12 months, we're going to go out there and we're going to raise capital. And then they raise a certain amount of dollar of capital. And they have an idea of what they want that portfolio to look like. And as the fund closes, they go ahead and they build up that portfolio. And there's an investment period that takes place. And usually that can be anywhere from 3 to 4 years where they're putting those dollars to work. It's not till you get to like year 5 where you really start to see, okay, this is what the portfolio is going to look like from years 5 to years 10, right? With the idea that in year 10, you're looking for an exit, and then you're going to start the process all over again, right? With an open-ended fund, it's in perpetuity. So the investment period is ongoing, and there's no lockup period that puts you in for 10 years. Typically, a lot of these open-ended fund structures like ours will offer some bits of, say, quarterly liquidity or semi-annual liquidity, where if clients need to get their money out, they can. With that being said, we tell all investors that these are long-term assets. Folks should really be thinking them as, 5+ years anyway. It's nice to have the idea that the flexibility is there for the liquidity if you need it. We know things happen. People have life circumstances that happen, deaths, divorce, etc. They need to get their money. But under normal market conditions, that capital, can be returned without having to wait until the 10 years is up to get that money returned back to you. So that's really the evolution that we're seeing in the market. It's like, how do you take the benefits of private assets, the risk return characteristics of what all these pensions funds have been experiencing, and bring them down and making these products more palatable for the retail market. There's still liquidity risk there. Let's be perfectly clear. Let's be perfectly clear. But you're offering a little bit more flexibility in there.
Mm-hmm. That's exactly right. So I know you wanted to show some slides, Eric. This might be a good chance to transition to that. But while you do, I can just kind of highlight the conversations that Cary and I have had for the last couple of years with regards to the diversification journey that we've been on. We've been an investor in the fixed income side of the markets and the equity side of the markets and the publicly traded real estate investment trusts. But after that, we've been thinking of like, how do we expand the diversification for our clients to make their portfolios over time safer, and also to give us opportunities for a different stream of return. And our first foray into that officially was Canadian farmland. And then we looked hard in the marketplace with regards to real assets, and spend a lot of time reading about what you guys are doing at Manulife. And we were very much interested in that diversification that you've built in with a possibility of some reasonable liquidity.
Yeah.
It's not a guarantee, but that to us was important. We got mums and dads that are counting on us here for delivering their capital back first and foremost, and then second, to get a reasonable rate of return. So that's where we're coming from. We want that to be delivered, not only for 2024, but 2034 and 2044 and on, right?
Absolutely. Yeah. Well, I can tell you, we're in it for the long haul. We're not performance chasers by any way, shape, or form. We're long-term investors. The pensions that we're running have 30, 40, 50-year liabilities and lifespans associated with them, and we need to obviously be there to pay benefits for folks in years to come. So, when we built this product, we really built it with that mindset in place, that's what we really wanted to do.
Eric, is it fair to say that this fund, the Manulife Real Asset Investment Fund, piggybacks on the skills that Manulife has built over decades of managing pension funds and insurance liabilities?
Absolutely, yeah. Well, this is a newer product. It's certainly not new to us. Manulife as a whole, obviously a large insurance company. We have a long, deep heritage there. And I put up some of the kind of three pillars of what we say is the advantages of this product, and all the way on the right you see the Manulife Advantage, and really that is really linked to the fact that in some cases we've been investing in private assets for over 100 years. I mean, we look at real estate as part of the insurance company's balance sheet. We've owned that.
Mm-hmm.
Timberland and farmland has been really deep in our heritage. We're the number one timberland investor in the world. We have over 25% of the investable timber market, and we're number two in agriculture investing globally.
How much would that be in? How much would that be in Canada versus the United States?
It's global, mostly in the United States, but we do have quite a bit in Canada as well. The farmland is roughly about 15 billion. Timberland is very close to that as well. We do have timber properties up in Vancouver area, all the way on that side, but also, in broader northern Canada. But the U.S. obviously is a huge market. U.S. South, Pacific Northwest, big on the farmland side. California and Midwest are really, really big. And we're also, outside of our investments at Manulife, we will invest in third-party managers. So I do think, feel that's important to note, because while we have a deep heritage and deep experience in this, we're not experts in everything. And frankly, even if we are experts in certain areas, we may not have the pipeline at any given time or the deal flow. So for me, inside of our multi-asset solutions team, we're open architecture. So I don't get compensated whether assets go to Manulife or not. My job is to deliver an outcome, to deliver a solution, it's to maintain diversification, and that includes a mix of both proprietary Manulife, but also third-party funds. In Canada, it's the Bonifield Canadian Ag Strategy.
Yeah,
I believe you're familiar with.
Eric, can you take a minute and just show us how you've built the Manulife Real Assets Fund? And just at a high level, and then maybe we'll talk about the recent experience, and then after that, maybe some final thoughts about real assets as an investment category.
Yeah, sure thing. I mean, this is a bit of an eye chart here. I won't go too crazy, but I think the main takeaways here is we have a mix of public and private, and you have 71% of it which is in private investments, and the rest is in public assets. And really what that does is that gives us as managers the flexibility to help in terms of not only providing liquidity, but also calling capital. So part of these types of investments, and one of the challenges that has taken place inside of the industry, is not just the capital intensive nature of you need a huge dollar amount to get into these assets. And yes, we can provide that scale, but a lot of times it has to do with the administration of it. The things we don't often talk about as much, which is like, Marshall, if yourself or Cary commit capital for a client, you can commit that capital right away and we can call it immediately. We can invest it in the public sleeve, but the client gets the experience of the entire portfolio, so that you're not making a capital commitment and I'm not coming back to you 6 months, 9 months, 12 months down the road with continuous capital calls on that commitment. That's time consuming. It's an administrative burden. It obviously takes away from you all in terms of overseeing your clients' portfolios. So that one of the benefits there is not just the investments and the investment structure itself, but how we've structured it so that we've made it easy to do business, in these
Yeah.
types of assets.
Yeah, and I mean, just to add to that, we were looking at the other real assets fund at Manulife that did not have the mix of publics and privates, and after some due diligence, we thought that this was a much better fit for our firm and for our client base, just because it did provide a reasonable amount of liquidity expectation.
Absolutely, yeah. The institutional fund, has obviously is a little bit more. It's a year, we have a year to return the capital if you put a redemption request in, whereas this fund is quarterly. But everything's a trade-off.
Mm-hmm.
You have a little bit more publics, which means you're taking on a little bit more, variability, but you're still getting enough private assets in here to experience the risk return characteristics of the institutional fund.
And do
So
you think that 70-30 mix is going to remain in the long-term life of the fund?
I do, yeah. I mean, frankly, last year was a difficult capital raising year. I think we saw the markets, equity markets, obviously going pretty well, and rates were up where they were. So a lot of folks are sitting on the sidelines, getting good cash yields. One of the benefits of having, not a great capital raising year last year really had to do with the fact that we were able to ramp up and get to our target mix. So this 70-30 split is our target. That's where we are. It's where we want to be over the long haul. So, for us, and we did a lot of modeling around this without getting into the weeds on modeling, but, our job is to look at the different scenarios, see how they play out. What's the right mix? Is it 60-40? Is it 30-70? And obviously I have a lot of risk folks that are, within a large insurance company that are always looking over my shoulder going, okay, show us the worst case scenario.
Yeah.
So 30-70 is really where we landed in terms of really being able to deliver the risk return characteristics and experience of the institutional investors, but having enough flexibility in there to not only call capital in immediately into that public sleeve, but then return it on redemption requests that come in. And from there, we'll move from the publics to the privates behind the scenes. So you folks don't have to worry about that. Your clients don't have to worry about that. We're actually taking the care to model and determine where the best place to allocate that capital is based on various different types of factors. Liquidity is one of them, but obviously, our mantra is we want to allocate capital where it's going to be treated the best, and at any given time, we want to push assets in that direction, and that comes back to some of the common discussions around around real estate. Last year we didn't commit a single dollar into real estate. We all know what's going on in the real estate market. There's been, with higher rates, drawdowns on valuations, and we chose to take a pause and sit back and kind of wait. And we're starting to see some freeing up in the market a bit. We've seen write downs of 10-15% across the real estate market. I think we're going to continue to see some headlines there, but things are starting to loosen up a little bit, I think. As we get in the next couple of quarters, we start to see an environment where, the Fed decides that they're going to start cutting. I think we'll start to see some more movement there on that front as well.
Hey, Eric, from that perspective, does what's happening in commercial real estate in particular and interest rates, is that negative for this fund, or do you see that as a positive that things are freeing up now with write downs? What does that look like for this fund and for the work that you do? Is it an opportunity or is it a drawback, or both?
It's both. It's been a drawback for the last year. Listen, there's a lot of negative headlines on commercial real estate, particularly office. Of our real estate portfolio, roughly 25% of it is in office. Of the office that we have, it's very high quality. It's assets that are in good areas that are fully leased and frankly are paying. Unfortunately, when you have a broad market trend, you have to go along with that in a lot of ways. And when the write downs happen, you get hit. It's like kind of throwing the baby out with the bathwater, I like to say. Like you're just kind of along for the ride. So like Q4 was very difficult, very challenging. I think we saw a good amount of write downs flowing through. And the one thing about about the private assets is it tends to be a lag. So it's always playing a little bit of a catch up in terms of the broader market as a whole, and typically a quarter lag in terms of valuation. So as you started to see drawdowns and REITs, you knew kind of that was a leading indicator that you were going to start to see some pullback in private real estate as well. For us, our managers that we have in US, Canada, and Europe, they're not putting any new money to work in office. Office isn't transacting. I think we're all kind of waiting to see how the evolution of office takes place. Most are going back to work. I can tell you, we're going back 3 days a week now. Some folks are 4 or 5 days a week now. The hybrid work is there, but the full remote, I think, is gone. Folks are looking at figure out how to operate their office space, and the leaders that are going to emerge out of that are going to be your higher quality type A class properties that are ESG friendly and whatnot. That's what you're going to see the emerging. We saw US and Europe take a bigger hit than Canada. Canada real estate market seemed to hold up okay, relatively speaking. There was definitely write-downs there, but nothing compared to Europe. As a result of the drawdowns we've seen in Europe, we're also seeing opportunities come about. Large investors like your KKRs and your Blackstone, coming to market with huge pools of capital are able to take advantage of some of this dislocation where they can step in and buy properties lower than replacement cost values. So, as we start to see more of that kind of stuff emerge, I step back and ask myself, all right, well, if we're going to start turning the tides on rates and more of these bigger managers that, frankly, in a lot of cases have a lot more experience than me in those particular areas, they're coming in and they're moving in, you got to start asking yourself, okay, what's out there? What do we think is going to be the next tailwind? So I think you are going to see some opportunities there. Infrastructure continues to be, for us, a really important place when you start to see huge amounts of areas like wind and solar and data centers and EV and all of that really having a lot of capital, a lot of funds going in those areas. There's been huge tax incentives that have been put in place to, incentivize the new capital over the next 10 years to be going into that space. So I think we're going to see more there on that front.
So Eric, do you think, recognizing that there's been issues in real estate and folks continue to be a little wary, do you think that maybe this is a softball? I should pause myself maybe on this end, but do you think this is a good spot for new capital, or do you guys have concerns around how you're deploying capital? What do you think as far as the opportunities for a diversified fund like this versus, some straight real estate?
Yeah, I think it's a great spot for new capital. I mean, obviously, I'm biased because I run this fund, but when you take a step back and you look at where valuations are and you look at where the opportunities are, in particular for this fund, we're going to have roughly about a third of the assets in real estate spread across Canada, US, and Europe. We're also in areas like multifamily and industrial logistics assets. So our real estate is diversified and it's higher quality. As we said earlier, it's that kind of core plus, lower uses of leverage. So our managers aren't stacked up against huge debt maturity walls that a lot of people are going to be coming up against here over the next year or two. So when you couple that with the fact that we're on the horizon of potential cuts and that there is a lag, I think we're going to start to see some tides turning a bit here. There'll be tons of opportunities in infrastructure and transportation, renewable energy, and for debt. So both on the debt and on the equity side, we're seeing opportunities there. And on the ag front, timber has been a little bit of a lag. I think, until we start to see a turn in the housing market in terms of new construction, it'll take, I think, a little bit for that to play some catch up. But, by and large, I think if folks are looking for, an allocation to real assets in their portfolio, it's certainly a good time to do that.
Very good. Eric, this has been a really interesting update and a review, and I really appreciate your willingness to spend some time. Cary, any burning questions on the real asset front before we ask? I've got one really, really important question to close. you're in Boston, we're in Edmonton. Give us like 30 seconds on what we need to see in Boston when we get there. What's the restaurant that we have to check out? Give us the insider track here on Boston.
I'll give you the insider track. Yeah, listen, I've been up in Boston since 1994. So I'm originally from Long Island, New York, and but so this is my home. This is where I live. But Faneuil Hall obviously has a lot of history to it. So if you're going to come to Boston, you have to visit Faneuil Hall. That's an area that has a lot of restaurants, and it says Quincy Market and whatnot. But a newer area that's really been built up over the last 5 years is the Seaport District. And frankly, I was working back down at the Seaport District. Manulife had a building there in 2006, 2008, and there was nothing. And now it's quite the scene in terms of how they built it up with restaurants and condos and shopping and whatnot right there on the water. They've really maximized the waterfront of Boston, which was frankly being misused before. But two great areas, I would say, to hit would be the Seaport District and Faneuil Hall for sure.
Very good.
Marshall, you're far less selfish than I am. I thought you were going to ask if Eric had an inside scoop on Stanley Cup tickets when the Oilers meet the Boston Bruins in Boston.
I don't dare talk hockey with you all up there. I know my place. I stay away from that one.
Right on. Right on.
Today's been great, Eric. Thank you very much, for your time. Really appreciate it.
Absolutely. No, my pleasure. I appreciate it as well. Look forward to chatting with you more.
Thanks, Eric.
Thanks, Eric. Have a great day.